Hi everyone, Andrew and I wanted to discuss the Backdoor Roth IRA strategy with you today. It's a strategy that we work with clients every year trying to help them get more money into a Roth IRA. Maybe they're phased out from being able to make a contribution. And first I want to talk about just the different types of these retirement accounts. I mean, when we say IRA, we're referring to a pre-tax IRA, which is a retirement account for individuals. Normally you get a tax deduction if you put money into it, but on the flip side you would have to pay tax on that money when you withdraw it down the road. Whereas a Roth IRA acts exactly the opposite. The money that you put into the Roth does not give you a tax deduction today. However, the money will grow tax-free over your lifetime, including when you withdraw it down the road. And other folks may have access to a 401k or a Roth 401k. It's the same concept. Those are just company retirement plans, whereas the IRA and Roth IRA are retirement accounts for individuals. And even if you have a company retirement plan, you may be able to do the IRA as well.
So, a question we get asked is, should I contribute to a Roth or to an IRA? And it largely depends on which are you going to pay less tax on in the long run. The IRS is going to get their tax on the front end or the back end. With a traditional pre-tax IRA, you get the tax deduction in that year on your tax return, so it lowers your taxable income, lowers the tax that you pay. But on the back end, when you do have to start taking required minimum distributions, or when you take money out, you pay income tax at the time. So the Roth is, on the other hand, it's after-tax dollars. You don't get a deduction on the front end, but when you pull it out after 59 and a half, you don't pay tax on the withdrawals. So, part of the question is, when are you going to be in a lower bracket? And that's hard to answer because the brackets can change. We're at historically low income tax brackets. So we really encourage those in lower brackets, if you're just starting out in your career, to forego the tax deduction now, make a Roth contribution, because you're going to get tax-free growth, and then you'll also get tax-free withdrawals in the future when presumably your income's going to be higher and you'd be in a higher bracket.
Yeah, Roths are great for folks that are just starting out. Maybe their income is their first job. If you're in the 10 or 12% tax bracket, it's really a no-brainer. You want to do Roth. Don't take that tax break today. I always refer to the 22 or 24% brackets as a little bit more gray. Sometimes there may be a compelling reason for why you contribute pre-tax. Perhaps you're trying to save, but that tax deduction helps enough with your cash flow that you can save a little bit more. And the Roth, however, again, without that tax bracket, without that tax deduction, you're basically saying, hey, I'm happy to go ahead and pay my tax today. And so you got to be thinking about historically where our rates have been. What is your rate going to look like down the road? Of course, nobody really knows that, but it's pretty safe to feel like we're in a pretty low tax rate environment right now. It's important to understand that a Roth contribution is different from a Roth conversion. And we're going to explain that a little bit more here, but you've got to understand that when you're converting it, there are a few other caveats that you need to pay attention to. With a Roth in general, there are caveats as well. Like if you open it up, say you're 60 and you want to pursue this, even though you're over 59 and a half, you're going to have to leave that Roth IRA open before you remove any of the growth in the future. You got to leave it open for 5 years. So the bottom line is there's a lot of nuances here that you need to pay attention to. Call us. That's a little, what we're here for to help with. We're trying to convey somewhat just the concept here of what is different about making a Roth contribution versus a backdoor Roth that involves converting.
Right. And so a Roth contribution versus a Roth conversion. Contribution are dollars, after-tax dollars, that go directly into your Roth IRA. A conversion is money that goes from an IRA into your Roth IRA.
Or a pre-tax 401k converting to a Roth 401k.
Right. Same idea. So there's rules around all of this. The IRS makes it a little complex, but if you're over a certain income level, you can't put money directly into the Roth. You can't make a direct contribution. But there's a workaround that we look at every year with clients where you put money into an IRA, You don't take any deduction because your income's too high. You immediately move it into your Roth IRA. That's the backdoor Roth conversion piece of it. And then the money grows tax-free in your Roth.
And so in essence, you're getting to do a Roth contribution. It's called backdoor because that's just how we know that it's a separate strategy where you've got to funnel it through your IRA. And backdoor, it can sound a little bit shady, but it's completely legitimate. The IRS knows about this. They actually intentionally don't give guidance in some areas of this strategy, possibly just to change their mind in the future on whether we can do this or not. Because that's another thing, is that there used to be income limits on doing a conversion. So this wasn't even possible until I think it was like 10 years ago or so when they lifted the income limit on converting. So it's great. There's just, again, many complexities to it.
So John, what are those income limits?
So if you are looking to contribute to a Roth IRA, you have to know what your modified adjusted gross income number is, which is basically your adjusted gross income with some non-taxable items added back in there. But for a married couple, you're able to contribute to a Roth IRA if your modified adjusted gross income is $218,000 or less. So and that's both of your incomes combined. If you're married, it's a joint tax return, so that's what applies. If you're under that limit, you're in the clear. You don't need to worry about this backdoor Roth. You can just contribute straight to a Roth IRA. However, if you're in the $218,000 to $228,000, you start getting phased out. And so if you're halfway in there, you can only do half of the annual Roth contribution limit, which for 2023, if you're under the age 50, it's $6,500. If you're over 50, you get an extra $1,000, so it's $7,500. Once your income, your modified adjusted gross income, is over $228,000, you can't contribute to a Roth anymore. You cannot directly put that money from your bank account into your Roth IRA as a contribution. Now, for individual tax filers, that phase out range is $138,000 to $153,000. So, and those change every year. I mean, those have been increasing over the last couple of years. So you've got to pay attention to it if you're real close to that border.
Oh, and for 401k plans, there is no income limitation for Roth contributions if there's a Roth 401k option within your plan. Also, those contribution limits are much higher. If you're under 50, it's $22,500. If you're over 50, it's $30,000. So IRAs, Roth IRAs, traditional 401ks, Roth 401ks, there's a lot of rules surrounding them, but the basic concept of pre-tax versus after-tax is the same.
This backdoor strategy kind of hinges on the fact that you don't have any pre-tax IRA money in an IRA today. If you do, it can basically prorate it to where if you try to contribute to an IRA with no deduction, we can't say to the IRS, hey, we're just converting the non-deductible dollars. They're going to prorate those dollars over the whole balance of the pre-tax IRA. One thing to consider, though, is if you have a IRA today with pre-tax dollars, and if you have a 401k that you're contributing to through your company, a lot of companies will allow you to actually roll your IRA into that 401k so you can shelter those pre-tax IRA dollars and then set yourself up to be able to do this backdoor Roth strategy. So Andrew, just walk me through what are the exact steps of how you help a client do a backdoor.
Right. So we're assuming that you don't have a pre-tax IRA. And so, to John's point, if you have 3 IRAs, they're going to look at all 3. They're going to look at the combined. You can't say this is my non-deductible, this is my pre-tax. They're going to look at all your IRA money. So let's assume you don't have a pre-tax IRA. You put $6,500 in my case for 2023 if you're under 50. I put $6,500 into an IRA. It's a non-deductible contribution because my income's too high. I'm not getting a deduction. It's under certain income limits, which we'll show you, and we'll assume I also contribute to my company retirement plan. I take that money in the IRA. It's reportable on my tax return. It gives me basis because I didn't get a deduction. I immediately move it or convert it to my Roth IRA. Once it's in the Roth, it grows tax-free, and down the line, withdrawals are tax-free. So that's the power of doing this strategy every year. A Roth IRA and an IRA in retirement, if they're the same value, I'd rather have the Roth because I can pull it out tax-free versus the IRA. I'm going to have to pay income tax upon withdrawal.
Uncle Sam gets some of your IRA.
That's right.
So it's not all yours.
That's right. So it's fairly easy to do, but those are the mechanics. You put money into an IRA, you immediately move it into the Roth, and it has to be cash going into the IRA. You convert the cash to the Roth, and then you invest the cash once it's in the Roth.
As you can see, there's a lot of nuances. It's even kind of complicated to try to explain in a short video. If you think you're interested in this strategy, please call us. We're happy to talk to you about it, help you understand, does this make sense for you, and how to go about getting those dollars into the Roth IRA so you can build a tax-free bucket. So thank you for watching, and we hope to have more videos like this in the future.